Hey, welcome to our Thursday's TRG Lunch and Learn. Today we have Stu Levy. He is the best.
Go ahead.
The best CPA in the South Bay. Stu's also a past president of Torrance Rotary. We've known each other for years, and he's a nice guy. He's also one of our preferred vendors, so if you ever have any questions about doing any of accounting, he will make himself available for you and your clients. Stu, it's all yours.
Thank you. Hello there. As Durf said, I'm Stu Levy, and I'm a CPA. And a couple of weeks ago, a client called me and said she sold her house. And she said that she was concerned how much she was going to have to pay in taxes. So I said to her, how much you sold your house for? And she said, $1 million. And I said, okay, how much did you buy your house for? And she said, $200,000. I'm pretty good at math. I said, $1 million minus 200, that means you have an $800,000 gain. You're single, that means you get a $250,000 exemption. So you'll be paying tax on $550,000. And she said, what about all the money I put into my house? And I said, oh, you didn't tell me that. So what hit me at that point is that one of the best things you can give to your clients when they buy a house, or, and we'll talk about it later, when they go to sell a house with you, is a way to organize what their cost basis is. Cost basis is a very important thing to accountants. There are other reasons that this answer is not necessarily going to be the best thing for cost basis, but let me go into it a slightly different way. So I recommend that people get a folder, just like this. Simple two-side folder with clips. When you buy the house, you put a side here for a list where you handwrite things, or you can write it on your computer and update it, but I'm a handwrite guy because you're going to update this regularly. And on this side, you're going to put all the receipts. So the first thing you're going to have is you're going to buy the house. And in this lady's case, she bought the house for $200,000. So she's going to have here a piece of paper that said bought $200,000, and here she's going to have the purchase escrow. Then she's going to have moved in, and she's going to say, put in new windows. And so she's going to say, put in new windows, $10,000, and here's going to be the receipt for the $10,000. And you're going to build this file. And the day you sell the house, you're going to go to your accountant and say, I sold my house and I put this much into it because that's the number on that list. Now, it's important to know what goes into the basis of a house. And it's slightly different than a rental property. And I'll go over the rental properties in a second. But with a house, you want to capture everything that you've spent on the house. So a story that I'll tell you, and I tell more stories than I do. I don't want to quote the Internal Revenue Code to you. It's very boring. But I had a client who bought a house in Redondo Beach in the 1960s. And he tore it down and he rebuilt it. And then in the 70s, he tore it down again and he rebuilt it. And of course, in the 80s, he tore it down again and rebuilt it. And he told me how much he spent on each of those rebuilds, but he didn't have any of the receipts. So when he got audited, because he sold the house, and he sold the house for a lot more than he paid for it. In fact, he sold the house for a lot more than he thought he put into it. And the auditor said, okay, prove it. If I had one of these, I could have just gone in with this folder and said, here you go. The auditor was not quite so gracious. The gentleman told me he bought the house for $100,000. He rebuilt it the first time for $100,000, rebuilt it the second time for $150,000, and rebuilt it the third time for $200,000. I added up all those numbers, compared it to the sale price, subtracted his $250,000 exemption, and he still wound up paying tax on about $400,000. Unfortunately, after the auditor finished with him, he wound up paying tax on about $500,000 because we tried to put together every receipt we could find, but we couldn't find it. It's become an item of interest to auditors since the exclusion, the section 121, sorry for the code section. Section 121 exclusion is the one that says if you've lived in a house for 2 out of the last 5 years, you get, as a single person, a $250,000 exemption, and as a married couple, a $500,000 exemption, which is the two 250,000s together. So that's what you should give your clients when they're buying the house. When they're selling the house, you give them the same folder and say, can you go back and please accumulate all that information for me? And that will be what they give to their accountant, and they will be able to tell them how much tax they're going to pay. What goes into, what is the number that you want to put in when you're improving a house? So I said windows, flooring, if you're putting in new hardwood floors, if you're re-roofing, water heaters, not little things like painting or small plumbing projects, but any kind of major plumbing project is something that you would be interested in capitalizing and including it in your basis. So in order to do that, again, it's important that you keep these records. I'm going to step aside for a minute and go over to rental properties, because rental properties, we actually track the basis on a depreciation schedule. And there are specific rules about rental properties and what you can and can't expense. There's a section, I never remember the section, but there's a safe harbor rule that says anything under $2,500 you may expense. Anything over $2,500, anything over $2,500 you have to capitalize, which means you have to depreciate it. So if you put in a new bathtub in a rental property and it costs you $2,600, you have to capitalize that and depreciate it. And you depreciate it over the life of the fixture, which will probably be 5 years, could be 7 years. But you don't get to take that whole $2,600 in year one. If you can get that tub installed for $2,400, you can take the whole expense in year one, which is a nice thing. And the reason that that's relative to the sale of the personal property is you don't have such restrictions. And so, but you also don't get to write off expenses on your house. So if you have to put in a $2,400 tub in your house, you want to make sure that goes into that folder. And if you have to buy, or of course a $2,600 tub would also go into that folder, but you don't have the same restrictions. And I'd want you to encourage your clients to accumulate everything that they do. And it may seem small, but it is important that they do it because you need to know what they're selling. When you sell a house, you're also selling the fixtures that are there. I found this out the first time we sold a house. We had a great chandelier, and we just assumed, because we were 25 years old, that we would be taking the fixture with us. And we were told by our realtor at the time that we could not. We negotiated with the buyers and they allowed us to take the chandelier, which was very nice of them. But when you put in a chandelier, that becomes part of your property, and that's something you're not taking with you. So that becomes part of your basis. Dishwasher becomes part of your basis. Built-in stove becomes part of your basis. Refrigerator wouldn't be part of your basis because you're probably not selling that with the house, and it's a different kind of property. And taxes are always concerned with what kind of property you're selling. So by now I would have asked about 6 times if anybody had any questions, but I will continue to persevere, but please feel free. I saw Danny put up the thing that said, if you have any questions, you should ask. You should feel free to ask. I'm much better at interacting than I am at speaking. So you want to make sure that you're accumulating the information for this basis, because that is the key cornerstone for everything you do when you sell the house. Now, sometimes a married couple own a house and one of the couple dies. Well, under the current tax law, which is the one with the $11.5 million individual exclusion on the state taxes, as long as we have that law, there is something called a step up in basis. So this lady, if she was married and she bought that house for $200,000 and didn't do anything to it, and when she was married to her husband, and then 1 year the husband passed away when the house was worth $800,000. She gets, her basis steps up automatically from the 200,000 to the 800,000. So basically then you go into your folder and you start a new page because you have a step up in basis. And anything that happens from that day increases your basis. So if in this case that I just made up off the top of my head, they buy a house for $200,000, don't do anything to it. He dies, the house is worth $800,000. Her basis steps up to $800,000. She turns around and sells the house in 2 years for $1,050,000. Well, that's a $250,000 gain. Because she's lived in it for 2 out of the last 5 years, she won't pay any tax on that. So you want to just start, again, in that case, if she started at that $800,000, then she did a new roof, then she did new plumbing, put in a new bathroom, whatever she did, all that stuff increases the basis from the 800,000 and brings it up to where it should be next. It's really, you know, it's very basic to me because it's something I see literally every day. I know it's something that is foreign to your customers because they are not buying and selling houses every day for the most part. So it is something that it's a simple tool for them to use. And if they are using it, they are going to be able to make, selfishly, their accountants very happy when they turn around and sell the house. And it'll also give them some peace of mind. They'll be able to give a good answer and a side benefit. So you put in a new water heater, and you have the water heater receipt in your folder. 2 years later, let's say you got a 5-year warranty. 2 years later, you have a problem with that water heater. You know just where that receipt is. It's in your folder, and so you're able to turn around and say, "Oh, by the way, Mr. Water Heater Company, I had a problem with it and I need you to fix it." So that would be something that, oh, I bored somebody. I see somebody left.
Stu, and I've got a question also when you have a moment.
Yes, yes, sure.
A lot of our clients are selling their home, like your example, where it's about $1 million or somewhere in that 800,000, let's say, to 1.5 million.
Okay.
And typically they've owned it for a long time. So if someone has a gain of more than that 500,000, that's exempt. So let's say they have an $800,000 gain. So that's
okay.
about, just roughly, that would be 300,000
Right.
that they would have to pay taxes on.
Right.
I know we can't give any numbers to our clients, but for our own information, what is the tax liability on that for federal and state, roughly, on
So
300,000?
On 300,000, you're going to make me do math. So the capital gain rate for the most part is 20% on the federal side. So 20% of 300,000, that's 60,000, right? And on the state side, that's a little more tricky because the state of California does not have a capital gains rate. The state of California taxes you as ordinary income. And so that goes with your ordinary income rate. The ordinary income rate can be as high as 13.3%. So it depends upon what your other income is. If I'm going to tell somebody off the top of my head, I always tell them 40% because there's other things that go into the federal rate. So on the federal return, you've got not only do you pay the capital gains tax, which a lot of people think capital gains tax are bad. Capital gains taxes are good because it's at a lower rate. But not only do you pay the capital gains tax, but there's also the Affordable Care Act tax on any investment income. If your income as a married couple is over $250,000 or as a single person over $200,000, if you have, so let's say you've sold this house and you have this $300,000 taxable gain.
Okay, so when you say investment income, that applies to, I'm talking about your personal residence, right?
You're talking, yes, I'm talking about your personal residence.
Okay, because I know you can talk later about that, because I know if it's an investment property, then you've got to recapture your, so that's an additional tax.
Well, it's yes, kind of.
Okay, right. But
So-
on your personal residence,
Now with just a personal residence, but the person who's selling the residence has let's make it really easy and say they have a W-2 of $250,000. And so their income is going to be over $250,000. And so in addition to paying the tax on the federal return for that $300,000 gain, you're also going to pay what's called the Affordable Care Act tax, and I'm sure they have some other name for it, additional Medicare tax of 3.8%. And that 3.8% is just basically saying you didn't pay Medicare tax on this, and so we're going to make sure you pay Medicare tax on the gain on the sale. And that applies to any investment income over your $250,000 as a married couple, $200,000 as a single person. Any investment income you have over and above that is charged that additional.
you mean
3.8%.
500,000 for a couple and 250 for an individual?
No, I'm saying no. So the 500,000 just means that it's like you paid that for the house. So if I paid $200,000 for the house, and I'm a married couple and I've lived there for 2 or 5 years, and I sell it for $1 million. Let me say 900,000 because that's going to make the math different.
Okay.
So I bought it for 200 and I'm selling for 900,000. So I'm looking at it and I have a $700,000 gain. But, right, 9 minus 2, yeah. But I also have that $500,000 exclusion. So I'm only paying tax on 200,000.
Gotcha.
So if that 200,000 puts you over 250, then you pay the additional 3.8% on that 200.
Okay.
Okay, so it's really difficult. So that's why I usually wind up just quoting 40%, because the worst that happens is you've overstated the tax a little bit. The best that happens is you didn't.
And so what do you quote then, like if it's an investment, if it's strictly an investment property on the gain?
So it's strictly an investment property, then I'm looking at trying to figure out what the basis is. And again, I'm looking at the depreciation. So once I see the depreciation numbers, then I sit down and I say, okay, well, here's your capital gain section. And the recapture of the depreciation is really coming out as ordinary tax, basically.
Okay, so as us, as lay people and in the real estate, we probably should be saying 50%. Right?
It's probably not a bad way
gain.
to go. But again, you know what, so many people don't recognize what their gain is. They don't understand how the depreciation impacted their basis.
Right.
And so they're just going to tell you, well, because I just had a client contact me the other day. They have a second residence that they rented out for about 10 years, but they haven't rented it out in about 4, and they're selling it. And in order to determine properly the gain on the property, I needed to get from them how much depreciation had been declared in that 10 years that they rented it out. And so when that depreciation came back in, that got taxed as ordinary income. So that's the other factor with a rental property is suspended passive losses. And so if you have a rental property with a suspended passive loss, that reduces your tax in a good way, in a really good way, because that comes out as an ordinary loss. And so if you have, now let's say that we have accumulated $20,000 of passive losses that we haven't been able to deduct over the years. So we sell the house, bless you, Danny, bless you again. We sell the house and we're going to pay we're going to pay capital gains on the capital gain on the house. So we're going to pay that capital gains rate, and let's call that 20% for the purposes of this conversation to the feds, and 10% to the state. So let's call that 30%. I'm also going to then take as an ordinary loss, just as regular, so not at my capital gains rates, but at my ordinary tax rate, that $20,000 loss. And that's going to reduce further my taxable income. And that comes in really handy. First of all, you've been sitting on those losses all those years and not being able to claim them. So now you can claim them. And you also can If you're in a place where you're going over that 250, where you're going to pay the additional Medicare tax, you're going to have the opportunity to bring it back down and pay less of the additional Medicare tax. Does that make sense?
Yeah, so I'm thinking other scenarios that a lot of us have is if an heir dies, so how's that tax basis done? Like if I inherit my parents' home.
So, well, first of all, don't kill your parents. But again, that goes to the step up in basis. Just like if a spouse died, if you inherit your house from your parents. So my wife and I are married, and we have 3 kids, and we turn around and we both die together on the same day, and our house, which we paid $200,000 for, is now worth $1 million. Those kids get the step up in basis to $1 million. If it's a rental property, same thing. And in fact, this is really good. It wipes out all the past depreciation. So let's say that a couple bought a rental property in the 50s, and by the time they die, it's fully depreciated, and all they have left is the basis in the land. But then they die. And when they die, the basis steps all the way up to the current value, and all that past depreciation is gone. So if you turn around and sell the property the day after you inherit it, you will pay no tax, because in fact, you'll have a loss, because if it was, the basis stepped up to the value of the date of death, and if they sold it the day after they died, it's usually the same value, and then you get to deduct the commissions.
That's what I asked, like the commissions and
the other costs associated with that. So especially if the property is held in a trust, that loss passes through to the beneficiaries. It's harder, well, I guess if it's a rental property, it doesn't matter. The only time it makes a difference is if it's a personal residence. If it's a personal residence and it's sold in a trust, you get to pass through those losses. If it's personal residence and it's not held in a trust and it's just directly bequeathed to somebody, they don't get to deduct that loss because it's a personal loss.
So would anything change? Let's say like a parent dies and then you move into the house. Is there like a time limit on when those gains go away? Like if I want to sell it in 5 years or sell it in 1 year?
If your parents die today and the basis in the house is now $1 million, you move into that house, your basis is $1 million. You live there for more than 2 years, and as long as it's your personal residence, if you turn around and sell it, you now qualify because you've lived there for more than the 2 years, either the $250,000 or the $500,000 exclusion on the sale of the property. So if you live there for 2 years and the property only goes up $250,000, then you sell it at no gain. If the property goes up, and you're a single person, if the property goes up in value $400,000, you look at the $400,000 minus the $250,000, you have a potential tax liability on $150,000 capital gain. And again, the rest of the calculation goes along. But if it was a rental property, let's say your parents had a rental property, and when they passed, you moved into it. You moved into it, then you start at the basis of their date of death, at the value of their date of death. So that step up in basis is a really good thing. When people say, and this is, now I'm going to be a little political, people complain about the estate tax because it's a death tax. And it kind of is a death tax. And if you are Sam Walton or George Steinbrenner and your estate is worth a whole lot of money, yeah, you got to pay a tax that seems unfair. But for the vast majority of people, and certainly I think for the vast majority of people I know, their estate is not going to be over $11.5 million. And if it is, then they pay tax on the amount over $11.5 million, but their heirs get that step up in basis, and they can turn around and sell the property at no gain the day after they die. So that step up in basis is really important, and it only exists because we have an estate tax. If we didn't have an estate tax, we wouldn't have a step up in basis, and you would have to pass this folder along to your heirs when you died, because they would need to know what your basis was. Does that make sense? Does that answer the question?
Yeah, it does.
without getting overly political, I have a client, and I jokingly say he owns a city. He owns a local city, and he just owns about, I think, half the property in that city. So when he dies, his estate is going to be substantially over $11.5 million. But it doesn't matter because he's already gifted more than $11.5 million to his children. So he is not going to have an exemption. And so when he dies, the property is going to step up in value. The estate is going to pay tax on all of that property, but all of the heirs are going to have all that property at the current value, and they can turn around and liquidate the entire estate and just wind up with a lot of money, tax-free. I know they paid the estate tax on it, but that really wasn't them, that was their dad.
Did you have a question, Nina?
Yes, for rental properties, isn't there some kind of an exception on the tax if your capital gains is less than 40,000 and below?
No, capital gains are capital gains. There are different. Where I didn't want to go is the federal capital gains rates is contingent upon your income. If you're in the lowest tax bracket, your capital gains rate is 10%. If you're in the highest tax bracket, your capital gains rate can be a little higher than 20%. But there's no exemption on the amount of the gain. If it's a rental property, it's a business asset, and you pay tax on the gain. And again, if you're recapturing depreciation, you pay a little bit extra on that.
Okay.
Anybody else out there have any questions?
I think, you know what, this is a topic on which I've taken full day seminars, and it's really dry for me, and I've tried to only give you the highlights. Like I said, the key thing to remember on a personal residence is that the items you want to put into your folder as adding to the value of the house, you don't want to limit to that $2,500 that you can use on the rental properties. So you want to be a little more aggressive. This cost. The ability to capitalize stuff, and you just want to add everything you can into your basis when you're selling your house, because you want to keep that capital gain as low as you can. It's the you know, if you're selling the house if you're a married couple and you're selling a house for $500,000 or less, you shouldn't have any issues at all. But if you are selling it at all for more than $500,000, you want to make sure you capture whatever your gain is.
Do you have a question, Nicole?
Yes, hi, just a quick question. This is a little silly, but one problem that I'm currently having are my receipts fading after a few months or a year. It's hard to really see the receipts. I just wanted to know if you had any tips.
Scan them, and you can have them available to print out. You create a file. This is a paper file because I'm old-fashioned and I like having paper. And it's also easier to just grab that and give that to somebody. But if you scan them and create this file on a computer, you know, just create a folder, put it on a flash drive, update the flash drive whenever you do something to the house. That's a way to do it. But yeah, scan it as soon as you get it.
Thank you.
The IRS does take scanned stuff.
Any other questions out there for Stu? All right, well, I guess that's it. They want any free tax advice. So thanks a lot, Stu, for joining us.
My number, I know my card is at the office. If anybody needs me, I'm always happy to answer a question. I'm working remotely now, so you probably want to call me on my cell phone. And but again, that's on the card. And that's all I got.
Oh, one more question. I'm sorry. what about the transfer? Like if you sell your property to your kid, is there a
So,
tax rate
no,
on that one?
that's a property tax basis issue. So it doesn't, so if it's a legitimate sale between parent and child, the tax issue is this, the income tax issue is the same. But if you're transferring it from a parent to a child, you can retain the property tax basis. So when I bought my house for $200,000, my property taxes, and thank you, Danny, Prop 90 and Prop 60. The property taxes were based on my $200,000 and just on the additions that I've made. If I turn around and sell the house for $1 million, well, if I sell it to my kids, they can keep my property tax basis. If I sell it to a stranger, they can't.
Okay. Thank you.
My pleasure.
All right. Well, thanks, Stu, and we'll get your cards passed around and maybe get you on another lunch and learn, hopefully in person soon.
Yeah, I look forward to that, and everybody should be watching the Yankee game.
I'll be watching the Dodger game, but
Well, the Yankee game will go on first. That'll be better.
all right. Well,
All
thanks
right.
a lot,
Thanks
Stu.
very much, guys. Nice to talk to you all.
Yeah.